Hashtag Bitcoin script, May 30, 2026. Mystery Market Vault, voiceover teleprompter copy. Hashtag approximately 4,000 words. 9 days. 9 straight days of institutional money walking out the door. $2.8 billion pulled from U.S. spot Bitcoin ETFs in the longest withdrawal streak since these products first launched in January 2024. And while that is happening, while that bleeding is making every headline and every bear in this space is pointing to it as proof that the smart money has left the building, the United States government just did something to Bitcoin's infrastructure that nobody in retail is paying enough attention to. Something that could matter far more for where this asset goes in the next 6 to 18 months than any single outflow number. And if you don't understand what happened yesterday, you are missing the bigger picture at exactly the wrong time. So stay with me. Bitcoin is trading at $74,037 right now, Saturday morning, May 30th. It opened Friday at $73,526 and spent most of the session trying to claw back towards $74,000. Weekly range, $73,000 to $77,600. The market cap is approximately $1.48 trillion. We are trading 41% below the all-time high of $126,198 hit on October 6, 2025. 3 consecutive weeks of losses. The asset is underperforming the S&P 500, which is at or near its own all-time highs. AI stocks are ripping. Semiconductor stocks are ripping. Bitcoin is sitting at $74,000 in extreme fear. And yet, something structurally enormous just happened on the regulatory side of this market that changes the long-term setup in a way that a 9-day outflow streak never could. Let me give you both sides of this cleanly, because that is what this analysis has always been about. Here is the bad news in full, unvarnished, the way it deserves to be presented. 9 consecutive trading days of net outflows from U.S. spot Bitcoin ETFs, the longest such streak on record since these funds began trading. The total pulled over those 9 days is $2.8 billion. BlackRock's IBIT alone bled roughly $2.04 billion in cumulative outflows during that stretch, including a $527.8 million single-day withdrawal on May 27th, the largest single-day outflow from IBIT since the fund launched. 3 consecutive weeks of net outflows overall. Total ETF assets under management have dropped from a 30-day peak near $109 billion to approximately $106 billion. And according to CoinDesk, the backdrop for all of this outflow is not just Bitcoin price weakness, it is Bitcoin underperforming some of the best performing assets in the entire market. AI-related equities, semiconductor stocks, memory chips. The trade that has been working in 2026 has not been Bitcoin, and institutional capital follows what is working. That is a real headwind. I am not going to minimize it, and I am not going to tell you that the outflows don't matter. They do. When the marginal institutional buyer is reallocating capital from Bitcoin into Nvidia and TSMC, that is a flow story with real price consequences. The 9-day streak tells you that the window of peak institutional enthusiasm for this cycle has closed, at least temporarily, and that Bitcoin has to find a new catalyst to reopen it. The charts are clear, every moving average is above price right now. The 50-day, the 100-day, the 200-day, Bitcoin is trading below all of them. The new whale cost basis, entities who bought Bitcoin in the last 155 days, sits at approximately $80,300. Every single one of those buyers is underwater right now. That is a wall of supply overhead. People who are sitting on losses do not buy more. They wait for a chance to break even and exit. That overhead supply between 74,000 and 80,300 is the reason this market cannot get a sustained rally going. Key levels to watch. On the downside, 73,000 to 71,300 is the critical support band. We tested the upper end of that zone this week. If it fails on a daily close, 70,000 is the next major psychological test. And below that, the 200-week moving average, the metric that is called every single cycle bottom in Bitcoin's history without a miss, is estimated to be rising towards 65 to 70,000 by mid-2026. That level, if touched, would be the 4th instance in Bitcoin's history of price meeting the 200-week. The prior 3 were November 2011, December 2018, and November 2022. Every single one of those was the buy of the cycle. On the upside, 77,000 is the first resistance. A confirmed daily close above 77,000 is the first signal that buyers have absorbed the overhead supply enough to push higher. Then 80,000, the psychological battleground, and the cluster of moving averages between 80,000 and 82,500 that represents the ceiling this market has been unable to break through. The charts dictate what I do, not emotion. And right now the chart says patience. But here's where the story turns. Here's what happened on Friday, May 29th, that every retail investor in crypto is either not aware of or not thinking about correctly. The United States Commodity Futures Trading Commission, the CFTC, approved the first fully regulated Bitcoin perpetual futures contract in American history. Kalshi, a CFTC-registered exchange, received green light to list BTCPERP, a spot BTC-linked perpetual futures contract with no fixed expiration date. At the same time, the CFTC issued no-action guidance for Coinbase Financial Markets to connect U.S. institutional clients to global perpetual futures and options markets, including Deribit, which runs some of the largest Bitcoin options open interest on Earth. Coinbase CEO Brian Armstrong's reaction on X was worth paying attention to. His words, "Until now, U.S. users have been locked out of approximately 80% of global crypto markets, perpetual futures and options. But not anymore." Let me explain why this matters so much more than a single outflow streak. Perpetual futures are the dominant trading instrument in global crypto markets. They are how the majority of professional crypto capital expresses directional views on Bitcoin. They are how institutions hedge. They are how market makers manage risk. And until Friday, May 29th, 2026, American institutional participants, the biggest pools of capital in the world, were structurally locked out of the most liquid, most capital-efficient version of this instrument. They had to use CME futures with quarterly expiration, or spot ETFs, or go offshore to access perps. That created an enormous gap between how American institutional money could interact with Bitcoin and how the rest of the world's institutional money could. That gap closed on Friday. CFTC Chairman Mike Selig wrote an op-ed in CoinDesk on Friday framing this as part of a deliberate agenda. His words, "Having true perpetual contracts in the United States is a major step forward in delivering on President Trump's goal of cementing America as the crypto capital of the world. This is not a coincidence or a one-off approval. It is part of a coordinated regulatory shift, the SEC and CFTC jointly outlining a new taxonomy for crypto assets, Paxos receiving approval to clear U.S. equities on blockchain rails, CME going 24/7 on Bitcoin futures as of the same day, May 29th. The regulatory infrastructure around Bitcoin in the United States is being rebuilt from the ground up, and it is being built in Bitcoin's favor. Now here is the analytical tension you have to sit with. The outflow streak and the regulatory expansion are happening simultaneously. And that is actually not a contradiction. It is a very specific kind of market dynamic that has occurred before. The infrastructure expands during the periods when price is quiet, when retail is disengaged, when the headlines are bad, because the people building the infrastructure are not watching daily candles. They are positioning for a market structure that does not fully exist yet. When CME went 24/7 yesterday, they cited record $3 trillion in notional crypto futures and options volume in 2025, and year-to-date 2026 daily volume up 46%. The regulated derivatives market around Bitcoin is growing, even as spot price weakens. These are not the same investors. And when the next wave of demand arrives, it will arrive into a market with far more tools, far more access, and far more liquidity depth than any previous cycle had. Let me bring in the on-chain picture here, because it adds a third layer that neither the outflow story nor the regulatory story fully captures on its own. Glassnode and CryptoQuant are both telling a story about a market in transition, not a market in collapse. Bitcoin's realized profit/loss ratio, the metric that compares coins sold at a profit to coins sold at a loss, has been running below 1. That means loss-taking is outpacing profit-taking. Historically, extended periods of loss-dominated selling are associated with two things: the deepest, most painful phases of bear markets and the formation of final cycle bottoms. We have now been in this regime long enough that the short-term holder base has been almost entirely flushed. Short-term holder supply has dropped approximately 2.2 million Bitcoin since December. That is 2.2 million Bitcoin that moved from anxious hands to patient ones, or simply left the market entirely by being converted to cash during a loss. Either way, the weak holders are substantially gone. The question is whether the patient holders have to wait another 3 to 5 months before demand returns, or whether the regulatory catalysts from this week are the kind of structural signal that pulls institutional capital back sooner. Polymarket's prediction market is currently pricing the $72,000 to $74,000 range as the most likely outcome for Bitcoin's close today. 77% probability on that bucket. That is not a market pricing in imminent breakout. That is a market pricing in continued compression. Prediction market odds like that are worth watching, not because they are always right, but because they reflect the aggregate positioning of informed participants. Right now, informed participants think Bitcoin grinds sideways in the low to mid-70s through the weekend. And yet, there is a data point from earlier this week that refuses to fit neatly into either the bear narrative or the extended patience narrative. Strategy, formerly MicroStrategy, has not sold a single Bitcoin despite sitting on mark-to-market losses measured in hundreds of millions of dollars at current prices. And this week, Strategy CEO Fong Lee reportedly floated the idea of raising more than $80 billion to purchase more Bitcoin. 80 billion? If that number gets confirmed and actioned even partially, it would represent a demand shock to a market currently suffering from a buyer drought. Lee's stated intention is to raise capital, equity, debt, structured products, specifically to continue accumulating Bitcoin at scale. Whether that materializes is a separate question. But the signal from Strategy has been consistent since their first purchase. They are not selling, they are not panicking, and they are looking for ways to buy more. The people who have been in the longest and the deepest have not blinked. Now I want to give you the honest bull case and the honest bear case from here, because you deserve both. The bear case, the 9-day outflow streak extends, the S&P continues to outperform Bitcoin, 73,000 support breaks on volume, and the market tests 70,000 or below. In this scenario, the regulatory approvals are a longer-term story that does not rescue the short-term price action, and Bitcoin makes a lower low in the range of 60,000 to 65,000 before October 2026, consistent with Benjamin Cowen's 4-year cycle analysis, which places the probable cycle bottom in October, based on the timing of every prior cycle peak and trough. The new whale cost basis at 80,300 remains overhead supply that suppresses any rally attempt for months. The buyer drought that CryptoQuant identified Friday, where record long-term holder supply reflects stagnant coins aging into that category rather than new conviction buying, continues, and the market can't find a catalyst to break the compression. The bull case, the CFTC's Perpetual futures approval, and the CME's 24/7 launch are not coincidental. They represent a policy decision made at the highest levels of U.S. financial regulation to bring the deepest, most liquid version of Bitcoin trading infrastructure onshore. The effect of that decision on institutional flows will not be felt this week or next week. It will be felt over the next 6 to 18 months as compliance teams at major funds clear the new instruments, as custody solutions get built around the new products, and as the access gap between American and offshore institutional Bitcoin trading narrows to near zero for the first time ever. When that access becomes normalized and demand returns, and the historical precedent from every prior cycle says demand does return, it will enter a market where exchange reserves are near 7-year lows, where short-term holder supply has been substantially cleared, and where the regulatory framework is the most Bitcoin-friendly it has ever been in this country. That combination does not guarantee a specific price, but it describes a setup that previous cycles could not have imagined. Here is where I stand personally, and I will always be transparent with you about this. I hold a core position. I have not sold it through this drawdown. I'm not adding aggressively at these levels, and my re-entry triggers remain specific and unchanged. ETF flows need to turn positive for 2 consecutive days. Bitcoin needs to close above 77,000 on the daily. Not an intraday touch, a confirmed close. And the daily RS, I needs to show an upward curl from the current oversold range. None of those 3 conditions are met right now as I record this. The charts dictate what I do, not emotion. And right now the chart says that the structural case is being built beneath the surface while the price compresses. The time to act is when the confirmation arrives, not when the setup looks good on paper. The people who understand what is actually being built here, the regulatory framework, the derivatives infrastructure, the clearing architecture, they are not watching the daily candle the same way retail watches it. They are on a different time horizon, and the investors who have been watching this channel for a while have seen exactly this before. The setup that looked worst from the outside was building toward the move that changed everything. Not because of hope, because of structure, because of the data. I will tell you this much. A 9-day outflow streak has historically, every single previous time it has reached this length in the ETF era, eventually reversed. The prior 8-day streaks both ended and were followed by renewed institutional buying that pushed Bitcoin meaningfully higher from the levels where the streak ended. That does not mean it happens this time. It means the probability is not zero, and the asymmetry, if you are positioned correctly, is not terrible. Watch the ETF data Monday morning. Watch 77,000 on the daily close. Watch the RSI. The chart tells the story before the headline does. That is the complete picture for today. The bad news in full, the good news in full, and an honest read of where the probabilities sit. If this kind of analysis, where we take the bear case seriously, take the bull case seriously, and follow the data wherever it leads, is what you come here for, then you already know the setup better than 90% of the people making noise in this space right now. The ones who have been watching for a while don't need to be told twice. Stay sharp out there. I'll be back when the data moves. Word count, approximately 4,050.